Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial opinions, and make your own financial decisions. Today is Wednesday, September 14th, 2022, and this is Blockhead Traders Weekly. In this week's episode, we are going to touch on a couple of trades that I put on this week in the wake of the consumer price index that came out on Tuesday and basically rocked the markets. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. Hop in there. It's free to join. You can say hello to myself, Viper, a few of the other Blockhead traders. Also, look us up wherever you get your podcasts and find us there. If you can't find us, let us know and we will get it there. Last, you can check out thetagang.com/sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. But let's hop to this week's content, Viper, the markets and the CPI index. CPI, or Consumer Price Index, is a basket of prices that impact the consumer. It's put together by the Bureau of Labor Statistics, and they release this number monthly. It's always compared on a year-over-year, month-to-month, things like that. But it is a rough gauge of the impact of inflation, because a lot of what they track in their prices, they will see a trend up over time as inflation rises. As inflation recedes, that price index will show retraction and contraction. A lot of investors were really hoping for a good CPI number indicating that inflation had really peaked and was on the contraction. However, that is not what they got. They got a stronger than expected CPI number, basically indicating that inflation is probably going to be with us for a while. And of course, that upset the market because the market had previously been really pricing in the fact that inflation was going to start receding, which means the likelihood of the Fed reducing rate hikes, I should say, or kind of scaling back might be more on the table, and they might be doing potential rate cuts by the early 2023. And of course, whenever the interest rate is coming down, a lot of growth stocks perform very well. A lot of bull markets are formed. And so investors were really hoping for a weak CPI number, which would indicate that things in the inflation world are under control and the Fed might be slowing and even then potentially cutting interest rates in the beginning of 2023. Well, that did not happen. It came out quite strong, which of course indicates that the likelihood of the Fed to take more action on interest rates, hiking them to kind of get inflation under control, is more on the table. And then the likelihood of rate cuts coming at the beginning of 2023 becomes less and less. What that causes is a bunch of flight from equities, because when interest rates rise, equities do not become as much of a value proposition as when interest rates are low. So you see a lot of people selling things. They'll typically sell high growth names, tech names. They will flee to bonds, cash, things like that. And that's really what happened Tuesday. And I think it was one of the largest point declines in all the indexes. I don't believe in recent history we saw a decline like that. And you have to go back to, I believe, June of 2020 to see a decline like that. And that was really in the immediate ripples of the corona lockdowns and things like that. So this caused all kinds of market panic. And whenever you get massive drops in price and big panic selling, you get volatility rising. And that's exactly what we got. And Tuesday was maybe a sad day for a lot of people, but I kind of had a small hidden smile on my face because I love to sell premium, and this is the type of environment where that becomes more attractive. So I was actually not also expecting the CPI number. So I kind of thought that there would be a CPI number. I thought it would be largely in line. I figured we would either slightly trend up or go sideways. I did not expect a big move. However, Monday night, I actually started doing some screening for potential plays, just keeping my eye out because I have some capital that I want to deploy. I wanted to try to make some quick moves in the market, and I thought I'd get a couple of plays lined up. So Two of the plays that I had kind of picked out, I had on my back burner, I had them on my watch list. And once the CPI number came out and the market opened the way it did, I decided, hey, all of my thesis that I had thought about the night before was still applicable, even in a more recession-prone environment, even in the wake of the CPI news. The only thing that happened was my volatility got richer, and I was able to push my strikes farther out. So I decided to enter 2 trades that Tuesday morning. Now, the first trade that caught my eye is a ticker VERU, VERU, really don't know how to say it. It is a pharmaceutical company. Looks like they have some potential upcoming drug out there that is going through various stages in the FDA. This probably sets off a little PTSD for Viper and myself because pharma is it's just not a sector I recommend most beginners ever touch. It is incredibly volatile. It can incredibly whipsaw you. You can get news out of the FDA on a drug, a trial, anything like that, and you could be to the moon or you could be in the basement. And it's not one that I normally seek out, but it hit my screeners as just this ridiculously high volatility. So on my screener, it was basically showing a 95th percentile of volatility rank. And what that basically means is in the past 52 days, if I look at how volatile it's been and what the range of the volatility is, it's been lower 95% of the time. So only 5% of the time in the past year has this volatility been higher than it is today. So that is actually one of the things I look for. I typically look for something between 40% IV rank up to usually 60 or 70%. That's kind of my sweet spot. Sometimes when things are much higher than that, they're a little too sketchy for me. I don't touch them. Lower than that, there's usually not enough premium for me to touch. So this one's sitting at 95%. And so I decided to click on it and take a look. The actual implied volatility right now is over 300%. And this underlying was not an expensive underlying. So this is not a $100 stock, $200 stock. This was about a $15 stock, $16 stock when I was looking at it after hours. And for that amount of volatility on that particular low-priced underlying, here you'll see some of the stats about this trade. You really get what I call a lower risk trade. Remember, we always think about the worst case scenario. And so if I look at this trade, my thesis is, look, this thing is really volatile. It's probably going to hang out here for a while. I'll pull up the chart in just a second to show you where my profit and loss kind of sits with respect to the chart. But I collected $3.80 premium for a 20 delta strike. That is just unheard of on a $16 underlying. It's very, very rare to have that much. So because it was so low, the buying power needed to secure this trade was about $800. So collecting $380 by risking or putting up $800 in buying power, that's a 48% potential upside on what I collect. So a 48% return on that $800 of buying power that I put up, which is just, I even contacted Viper in the Discord trying to get him to talk me out of it because it's pharma and I just don't trade pharma, but it was just too tempting and I sold it. I think his advice said, well, that is tempting, but you better go make sure there's no events coming up, because that's the stuff. There's an episode, I'll link to it up above, where we went basically to what was the $6 and something to 5-10 cents in one tick.
SESN. Yep. I actually pulled that chart up to look at it, and yep, it was peaking up at $6 even, and then it went down to around $1.80, I believe. And a year later, nothing's changed. It's only gotten worse. It's at 64 cents currently. So that is pharma in a nutshell. Is hype. FDA says nope. no thank you, and then it is gone.
Yep. So that's kind of what I'm up against. And, I did look. There is an FDA event on this stock. I didn't really look into what is what because I think in SESN, the FDA kind of caught everybody by surprise. This event does kind of seem scheduled for October 6th. I plan to be out before then. So I don't want to hang around any sort of FDA events. I want to grab whatever green I can and go home prior to that. So I am going to keep that on my radar. Worst case, because you always got to prepare for the worst case, I'm going to end up buying VERU for $8.70 a share, 100 shares. That's probably where my buying power of $800 comes from, because the broker's like, yeah, this is pharma, so you might have to buy all this, so you're going to need to give me this much money. So that's really where that's sitting. But I'm going for that volatility contraction. And so let me just pull up here what this looks like on the profit and loss.
I'm honestly surprised that there's even an option chain on it because I feel like a lot of this stuff doesn't usually have options.
I kind of agree with you. I was very shocked when I saw that volatility. I thought for sure I'm going to click on this thing, go to the option chain, and it's going to be just crap. Because a lot of times you'll see these crazy volatile things. You'll go to the option chain and you'll see just no liquidity or not a lot of strikes. Maybe there is none. This actually was a very liquid option chain. So the bid and ask, you can always check for liquidity when you look at the bid and the ask price. And the closer those are together, the more liquidity they have in that particular chain. So some people look at open interest and things like that. I don't care to look at open interest. Yes, it's a nice benefit, but just because open interest is low doesn't really mean there's not liquidity, because you have a lot of market makers that are in there. And when you get the tight bid-ask spread, that is the greatest indicator for me to know that there's liquidity. And this particular spread, I think, was within a quarter. So it wasn't amazing, but it was definitely not terrible. Taking a look at the chart here, you can see what I've got is this is the recent. So this is basically roughly from February of 2022. You can see we're hanging out here around $4. Something happened, bumped this bad boy up to 13. And you can kind of see we've been stair-stepping a little bit, but also kind of just trading in this kind of band, this range of maybe a high of 17. We broke through that once. Maybe a low of around $10 or $8 or $10.50 or so, $10.80. So what I've got marked here is this green would be the range of price for 100% of what I collected. This yellow is going to be partial. So this is my below my strike, but because I collected premium, this is going to be my partial profit range. And I close this thing out here on the right as this is when the options expire. So as long as we stay in this green or yellow box before this end of this, I should be able to pull off some green on this one. And with this much volatility and the theta decay timing, it should decay pretty nicely. We'll keep you posted on how it plays out. But you can see that's a pretty solid $8.70 down here. Really, you'd have to drop this last swing up here.
Yeah, of which though I would cautionary tale of anybody I mean, and a lot of this like you said is just PTSD of pharma stocks and whatnot. But the drop below that previous swing with a major swing like that generally feels safer on a tried and true stock with a lot of volume and trading history and whatnot. But in this case, you can see the volume there kind of on the bottom of the chart. That big swing was really just people showing up. There was like no volume before that. So, I mean, I agree with everything that, yeah, you'd have to lose that for this to really kind of hurt or anything like that in the trade you set up. But the lose that part of the equation is that's part of the risk, because is it likely to lose it? I don't know. We'll see. That's where everybody showed up to the party. So
We'll see how much they want to hang around, because they could all just vacate.
yep.
So this one was, I would consider this a much more speculative play myself versus what I'm normally comfortable in my wheelhouse. So that brings me to the second play that I saw, and that is Carvana. So if we take it Carvana and we take a look at that again, this is another one that had very high volatility. So I mentioned I like between 40% IV rank and 70%. It's just a nice middle ground as far as showing elevation. This one was sitting at 57% historical volatility, meaning that 57% of the time the volatility was lower than where it is now. Volatility is always a mean reversion play. It just tends to go back to that mean. So whenever you get something that's elevated and stretched, selling the volatility is a great way to wait for that contraction to buy it back. My thesis here on Carvana is this was one of the COVID darling stocks, and it was up as high, I think, in the $300, maybe even $400. It's now trading at around 38 when I entered this trade, and the volatility premium for a 20 delta strike yielded $2.65. So I collected $265. Now, this is a higher dollar underlying. It has pretty good volatility. So my buying power was $1,200. So considerably more buying power than VERU, but about a 22% potential profit on that return on capital there. So, this is more in my wheelhouse, looking for about a 38 days to expiration here. Worst case, I'm going to own Carvana at $27.35 if you consider my $30 strike price plus the premium I collected. So if we take a look at Carvana on where does this range need to happen, we'll swing over to the chart. Again, this chart basically goes back to the beginning of 2022. You can see Carvana, was already on a slide. It was even higher than that prior to 2022. We have slid from the upper 100s all the way down. I think the low is around $19, and we started to kind of swing up here. So, it's a little bit on a current uptrend. This box that I've got here, this is really where I'm looking for my range to be. Pretty zoomed in here, but the green is my full profit. This yellow is where my strike starts to bleed off. This is my premium buffer to the downside. But remember, my trade here is long Carvana at $27.35. So worst case scenario, if it actually is in an uptrend and the most recent low is around $19, it's not great. I mean, $19 is a good bit below $27.35, but I'm really trading probability here. I'm trading for a volatility contraction. I'm trading for sideways movement, slightly up movement, just not a major drop down on Carvana.
Yeah, the only thing I would add is if we look at my chart here real quick, kind of like you said, I mean, if we're looking at historically, we were on a tear up to almost $400 at the peak there. And like we've talked about before, going back, once you lose the all-time high, going back to test the, ultimately test the bottom of the swing that made that high. And we can see that we kind of have done that. We were down there, we tested, and then we swung up and got resistance at the next level. And then we've kind of come back down. And so this isn't to say that it's not going to drop. But, playing those probabilities, needing that movement sideways, I would say there's certainly enough data here to suggest that sideways is more probable than continuing to lose and put you in violation of your profits or holding these shares outright. So, yeah, I agree. I think the volatility is there, and sideways is the order of the day for probability.
Yeah, and the last trade I want to just touch on a little bit. We'll switch back here. This is actually a trade we've been keeping tabs on. I think now this will be the third week in a row that we touch on it, and that's an Amazon trade that I put on. And I really want to call this one out because we just talked about sideways action. We just talked about the trade-off of owning the shares versus not owning the shares, and what does that do for you? Where do you fit on that? And so a while back, a couple weeks ago, basically back at the end of August, I put a trade on for Amazon. At the time, Amazon was trading for $130, and I sold a $115 put. That was a 20 delta. I put up $1,400 in buying power. It's about a 18.5% potential upside return on that capital. Ironically, I actually was chatting with Viper in the Discord on Monday, and I said, "Hey Viper, I think I got an idea for the show on Wednesday. Let's cover my Amazon trade. I'll close it out probably Wednesday because I'm at 60% profit today." That was Monday, and he said, "Oh, that's great. That'll show that real power of theta decay. How we got a little bit of a rally. It wasn't a huge move up, and." It likely was a less risk trade that I did versus holding the shares. Then the CPI number came out, and Amazon lost 7% on Tuesday. So gave back a lot of the profit I had burned off because volatility went back up and price came down. So I told Viper on Tuesday night, I said, well, my Amazon trade's back to even. I'm not losing money, but I'm basically not 60% up on my profit target anymore. So I guess we'll scratch that for a show idea. And then today, Amazon basically went up about 2.5%, I think, in the trading day. And my return or my profit on my capital basically went up 20%. So it's just a great way, and I'm going to pull the chart up here to highlight this, that you can see on this chart, I entered when the stock was at $130. Today, the stock is at $128. It's $2 less right now than when I opened the trade. But I'm actually up $50 on the trade. I got 20% of my money, my profit already. So the stock has gone down $2 a share, but I have $50 in my pocket. And that is the power of theta decay and volatility contraction. Now, volatility hasn't really contracted that much because it really spiked on Tuesday. So volatility is close to where I sold it. But you can see on this chart, it's kind of going sideways. And if you were long those shares at $130, you would be down $200 right now. Because remember, a contract is 100 shares. So I'm up $50, where the long holder, if they entered the same place I did, would be down $200.
So that's, first of all, yes, absolutely. It's the power of premium selling and options and, really what makes these great vehicles. But this is a big stock. And the idea of 100 shares of $128 stock is really intimidating. Like $12,800 is a lot to put up. So what options are out there? Pun intended, for somebody that wants a piece of this, but also doesn't have that capital to risk on the downside for assignment.
Yeah, that's actually a great point, Viper. Because a lot of what you can trade really is dictated by your portfolio size. And so, we have an episode about position sizing. I'll put a link up above there for our position sizing episode, because I think that is one of the most important parts in managing your trades, is to never trade too big. Know what your portfolio can hold and don't trade too large. And Amazon is one of those underlyings where it's probably too large for a portfolio that has maybe $2,500, $5,000, something like that, to hold 100 shares of Amazon. And that is where you have to basically add some protection or reduce your downside risk. So let's visualize this in the options window here. So what you've got here is, this is my Amazon trade. This is the P&L chart of the trade. The blue line is what my profit or loss will be at expiration. And so you can see it really flat lines up here, because when we sell premium like this on the put side, we are capping our upside gains. It's a boring trade. You're never going to hit a home run with this. You're just going to hit single after single after single. So my maximum upside here is $260. This blue line, you'll notice below my strike of 115 really just starts falling off into the nether, just deeper and deeper and deeper, and it will go all the way to zero. And you can see over here is the profit loss. So we're talking thousands of dollars of loss if Amazon goes down to, $60, $70, just crazy drop. You can see there is no limit to the downside. The limit to the downside is Amazon goes to zero. And that is just not an acceptable risk for certain portfolios, certain traders. So what do? Remember, we are selling options, and that is basically like selling insurance. So what you do is you buy insurance, okay? And the benefit of this is you're going to limit your downside fall. It's kind of like a stop loss order, except it's not because you don't close the position. But it basically is insurance that you're going to purchase to protect you from losing a huge amount of money. And the way you do that is we would just kind of go to the option chain here, and we would scroll to say, okay, I want to buy an option that's further away from my particular strike. And the width of that is basically the distance from the strike you sold. In my case, I sold 115. And if I'm going to buy an option, I might buy a 110 strike, which would be a $5 wide option spread. Okay, so I will buy this $110 strike. What this says is I now have the option to put 100 shares to somebody at $110. Okay, so think about that. I am going to buy shares at $115. That's what I sold. I said, you know what? I don't care how low Amazon goes. If it gets below $115, I will buy it at $115 from you. Well, I don't really mean that, because if it goes to like $50, I don't want to spend $115 on that. So I'm going to buy an option from somebody else who's selling options, and it's going to give me the right to put those shares to somebody else at $110. So even if Amazon goes down to, $50, I hold a coupon that says I'm allowed to put 100 shares to you, whoever sold me that option, for $110, which means my max loss is $500. Because that's the distance from the strike that I have agreed to buy them from to the strike that I am allowed to push them to somebody else on. And so if we take a look at what this looks like, you now see that on the downside, we get this sharp slope down, but it levels off. It does not get any lower than this. So what is this number that you see down here? This is the max loss, which in this case is $382. Now, I just told you the max loss was $500. It's true, but remember, you collected premium on what you sold. And so that max loss is $500 minus the premium that you sold. So in our case, I sold premium at about $118 when I factor in this extra option insurance. So just to show you here, no insurance, I will be collecting $260. What I can do is, of that $260, I am going to take $142. That's the price of this particular option. I'll slide it up here so you can see it. I will take and I will buy that protection for $1.42. That's going to eat into my profit, but it's going to protect me from the downside. So now, once I buy that, I only have $118 left of what I sold. And if we drop, I could lose up to $382. So remember, this is all about probability. And you might think, oh my gosh, this is not a wise thing. Why the heck would I risk losing potentially $382 $2 just to make $118? And the answer is because the probability of that happening really is, if I slide this thing down, you can see there is an 85% chance that you are going to profit on this trade. And so when you have high probability of success, your return will be lower. That's just how risk works. The less risky a trade is, the less you collect. The more risky it is, the more you collect, but the lower the likelihood that it will happen. What this does, not only does it allow you to trade Amazon, which might be an underlying which is too big for your portfolio, because this will have a maximum buying power of $500. So that is a perfect size for something that's maybe a $7,500 portfolio size, maybe a $10,000 portfolio size. That is a very small percentage of your overall portfolio, and that is worthy of risking that type of money. And what that does is, let's just say Amazon drops for whatever reason. I think Viper had done some charting on this, and he says, $100 Amazon is really not off the table when I look at the charts. It's not likely, but it's not off the table. And so if you take a look at my particular trade, if we were to fall to $100, I would be losing $1,200 on my trade because I have no protection to the downside. So every moment it falls lower, I lose more money. There is no limit to the downside until it hits $0. If we add this protection at that same $100 strike, you can see our loss would be $382. So you can really see the power here of this protection. It's taking that risk from losing $1,200 to losing just $382. So not only are you protecting yourself to the downside, you are also trading with a buying power of just $500, which is a lot more manageable for the smaller portfolios. Well, that brings us to the end of this week's episode. Viper, the markets, the volatility is kind of out there. There's a lot of uncertainty. This is really where premium selling shines. I'm glad we could take a little bit of time to chat on some of these trades here. It is definitely my wheelhouse of trading is this premium selling. Particularly, I just love the naked puts. It just gives a lot of the movement and exposure and decent returns. You can follow all of these things on thetagang.com/sprocket888. I post all these trades in there. And actually each one of these trades I dropped in our Discord before I made them. There was a couple other underlyings I was looking at that I also put in there. The community actually did a great job of just tossing up a couple of charts. I was kind of hoping people would talk me out of the pharma, but they ended up talking me into the pharma. So I don't know if that's a good thing or a bad thing. But it is a community that you can hop in, get some feedback on, hey, what do you think about this? What about this? Here's what other people, they'll just tell you what they think. Nobody's going to tell you what to do. Only you can choose what to do. A lot happening in the market these days, a lot of volatility. Next week, the Fed gets back together to talk about interest rates. They are anticipated to be raising by 75 basis points. There is talk of maybe even raising by 100 basis points. That is sure to bring more market churn. There will be market uncertainty leading up to that event. So good luck out there. Hope you have a good time trading. And remember, think outside the block.